Hi, I'm Dan Danford, and this is another episode of Money Made Easy for dadsdivorce.com. We have another great question that was posted by one of the viewers of the website. When evaluating my 401k, I find myself dissatisfied with the funds. I want to shift my money to different funds within the plan. When making this decision, which do you think I should focus on more? The fund's expenses or the returns the funds have earned? You know, I spent the first 15 years of my investment career as an employee benefit officer in the trust departments of banks. What that basically means is I took care of 401k and retirement plans for employers. Talked with a lot of people about how to invest their 401k plans over the years. It's a real key question. Of those two criterion, if you're going to say, you know, which of these two should I focus on, I would say focus on expenses first. Now, there's a little caveat to that though, and that's that you can't just compare expenses from one fund to the other. You have to look at expenses in the context of what kind of fund it is, okay? International funds will have higher expense ratios than domestic stock funds. Domestic stock funds will have higher expense ratios than bond funds. Money market or fixed income type funds may have the lowest expenses of all. So if you're going to compare expenses, compare bond fund to bond fund, stock fund to stock fund, international fund to international fund. Those basically, the different expense ratios just represent that it's more expensive to do research and manage a portfolio in certain sectors than it is in others. Many years ago, somebody did a very detailed study of what mutual fund attributes were most likely to be revealing in terms of how the fund would perform in the future. And they looked at 50 bits of information about each fund, and they compared them and tracked them. And when it came back, bottom line, fund expenses were one of the biggest criteria of why a fund performed well. Essentially, if you have higher expenses in the fund, there's less left for shareholders to enjoy. So I consider expenses to be very, very important. Now, performance is important too, but you have to look at that in certain ways too. If you move your money to the funds that have the most high recent returns, that's probably the wrong way to look at it. You're always going to be moving your money to funds that have just enjoyed great performance. Now, if you were looking at it purely from a theoretical standpoint, you'd want to buy into those funds before they enjoyed their great performance, not after they enjoyed their great performance. And the difficulty in predicting which funds are going to have the next great performance is what leads professional investment advisors to not play that game at all. This is how I manage my own money in my own retirement plan. I take the amount of money that I'm putting away every month and I split it between 3 or 4 different kinds of funds. I have some money that goes to an international stock fund. I have some money that goes to a large company U.S. stock fund. Some goes to a mid-sized company U.S. stock fund, and some goes to a small company U.S. stock fund. The portion of my portfolio that's not going to be allocated to stocks goes into a bond fund. I don't worry about which one of those is going to have the next great performance. I figure there's always going to be one that's performing pretty well, and there's always one that isn't performing very well. But part of the magic behind a 401k plan is I'm going to continue buying in every month anyway. So even when I buy that new money in, it's going to have me buy less shares of the high-performing fund and more shares of the low-performing fund. So as those funds shift, as their volatility shifts, as they grow in the future, I'll actually get more bang for my buck because I've put more money into the low-returning funds than the high-returning funds. That's called dollar cost averaging. It's mathematical, and it works with 401k plans. So I guess my simple answer to your question is focus on the expenses first, and then second, choose the fund that has the best long-term performance in those different categories. So choose a large company stock fund and choose the fund that has the best performance and the lowest expense ratio. Do the same thing for the other categories, and then reevaluate your funds every 3 or 4 years. I mean, watch them all the time, but every 3 or 4 years, get serious about switching them or rebalancing them or switching out the ones that haven't performed well. This is the strategy that I use with my own money, and it's the strategy that most professional people use in managing 401k plans because it's what works in the long run. I hope that gives you a heads up. If there's anything we can do, keep us posted on the website. Send us a note, tell us how you're doing, and further questions as you go forward. That's it for another episode of Money Made Easy for Dad's Divorce. I'm Dan Danford. Thanks, and we'll see you again next week.